Here's something I never once saw explained in a retirement brochure, a financial seminar, or even a Social Security statement in 22 years of practice. The day one spouse dies, one Social Security check disappears permanently, often within weeks, and most married couples have absolutely no idea it's coming until the surviving spouse is sitting alone, grieving, and suddenly trying to figure out why the household income just dropped overnight. I saw this happen again and again. Not because families were careless, because nobody ever explained the rules clearly. And by the end of this video, you're going to understand why the higher earners claiming decision may be the single most important survivor protection strategy a married couple ever makes. Not for themselves, for the person they leave behind. Welcome back. I'm Clara, and this is Wealth Logic, where we make retirement make sense. In 22 years working with pre-retirees, I sat across from more widows than I can count, who came to me not because they failed financially, but because nobody had warned them what would happen after a spouse died. Today, I want to show you exactly what catches so many families off guard and how to protect the person left behind before that moment ever arrives. Before we go further, everything in this video is educational, not personalized financial advice. Every family situation is different. Use this as a framework, then review it with a qualified professional who understands your full picture. That's how families avoid expensive mistakes. Most married couples, when I asked them this question, gave me the same answer. What do you think happens to your household's Social Security income when one of you passes away? And almost every time the answer was the same. Both checks continue, or the surviving spouse receives some kind of combined benefit, or there is a reduction, but a manageable one. Every one of those answers is wrong. And I understand why the belief persists. Social Security statements do not explain survivor rules in plain language. Retirement brochures do not cover it. Financial planning meetings rarely bring it up while both spouses are still healthy. The conversation gets deferred, and then it arrives uninvited, 3 weeks after a funeral, when a surviving spouse is sitting in a Social Security office trying to understand why her household income just collapsed. The actual rule is simple, and it is one of the most financially consequential rules in the entire retirement system. When one spouse dies, the SSA stops paying the smaller benefit entirely. The surviving spouse receives only the larger of the two benefits, not both, not a combination. The smaller check stops permanently. The larger check continues. I call this the survivor reduction, and let me be precise about what it means in practice. If you and your spouse are both currently receiving Social Security, your household is collecting two checks every month. When one of you dies, one of those checks is gone forever. For most married couples, particularly those where one spouse had a significantly longer or higher earning career, the surviving spouse loses their own benefit entirely and keeps only the deceased spouse's larger amount. For households where both spouses received equal benefits, the impact is even more direct. The household income drops by exactly half, overnight. I want to pause here because every time I share this, someone raises a very fair concern. They say, but we both paid into Social Security our entire lives. My benefit is mine. How can they simply stop it? And that is a completely reasonable thing to feel. But here is what the Social Security Administration's own rulebook shows. Survivor benefits were designed as income replacement for a household that has lost an earner, not as a continuation of two independent payment streams. The system does not add benefits together. It asks the surviving spouse to choose the larger of the two, and the smaller one stops. According to the Social Security Administration, more than 5.8 million Americans currently receive survivor benefits. The average widower or widower receives approximately $21,990 per year from Social Security. For most surviving spouses, that monthly check is the largest single source of income they have, and it is shaped almost entirely by decisions made years earlier, decisions that felt, at the time, like they were only about the couple. Now, here is where the widow's tax torpedo moves from painful to devastating. And this is the part most couples never fully think through until it is too late to change anything. The higher earner's claiming age does not just determine their own monthly benefit. It determines the floor of the surviving spouse's income for the rest of their life. I call this the claiming age multiplier. Whatever the higher earner decides about when to claim, at 62, at full retirement age, or at 70, that decision multiplies through every single month of the surviving spouse's retirement. Here is what the numbers look like with a real example. Take a couple where both spouses have a full retirement age benefit of $2,400 per month. While both are alive, their household Social Security income is $4,800 per month, $57,600 per year. The higher earner passes away. The surviving spouse's own check stops. She now receives only the larger benefit, $2,400 per month. Her household income just dropped from $4,800 to $2,400. That is exactly 50% gone overnight. Not because of a market crash, not because of a bad investment, because of a rule that was always there and nobody explained it. Over 20 years, that $2,400 monthly shortfall represents $576,000 in lost household income. That is the financial reality a surviving spouse is left to manage, often alone, often for the first time, and always at the moment when she is least equipped to absorb it. But now, here is where the higher earner's claiming age makes everything either significantly worse or significantly better. If the higher earner claimed Social Security at age 62, the earliest possible age, their benefit was permanently reduced by 30%. A $2,400 full retirement age benefit becomes $1,680 per month. That reduction is locked in for life, and when that higher earner dies, the surviving spouse does not receive $2,400. She receives $1,680 for the rest of her life every month. The difference between those two outcomes is $1,296 every single month for the surviving spouse. Over 15 years, a conservative estimate for a woman widowed in her early 70s, that difference exceeds $233,000. Same household, same lifetime of work. The only variable is when the higher earner chose to file. Let that sit for a moment. I want to be clear about one important detail here, because this is a point where I have seen viewers get confused, and getting it wrong is costly. The surviving spouse does benefit from the higher earner's delayed credits, but only if the higher earner passed away before filing. If the higher earner filed at 70 and received that larger amount, the surviving spouse inherits that larger amount. If the higher earner filed at 62 and received the reduced amount, that reduced amount is what transfers to the survivor. The claiming age decision is permanent in both directions, for better and for worse. Now, I want to tell you about someone I worked with, because I think her situation will feel familiar to many of you. Her name was Miriam. She was 73 years old. She had spent 31 years as a postal service clerk in Knoxville, Tennessee, the kind of person who knew every coworker by name and showed up early every single day for 3 decades. She and her husband Leonard had both worked throughout their careers. When they retired, both were receiving Social Security benefits of $2,400 per month each. Their household income from Social Security alone was $4,800 every month. They had planned carefully. They felt secure. Leonard passed away at 76 from a heart attack. It was sudden. There was no preparation for the financial conversation that came next. 3 weeks after the funeral, Miriam went to the Social Security office to report Leonard's death and ask what would happen to her benefits. The representative explained the rule. Leonard's benefit would stop. Miriam would receive only the larger of the two, which in their case, since both benefits were equal, meant she simply kept one check. One. instead of 2. Miriam's household Social Security income dropped from $4,800 per month to $2,400 per month, exactly in half, overnight. She came to me 4 months later. She was not panicking, but she was quietly terrified. Not because $2,400 per month was nothing, it was meaningful income, but because the life she and Leonard had built together, the budget, the travel plans, the comfort of 2 checks arriving every month, had been built on $4,800, and she now had to rebuild everything on half of that, alone. What struck me most about Miriam was not the financial problem. It was the look on her face when she said, "Nobody ever told us this would happen. We did everything right. We both worked, we both saved, and still, this was waiting for us and we never knew." She was not angry. She was just trying to understand how something this significant had never come up in 30 years of responsible financial behavior. The fear she was carrying was not really about the money. It was about not knowing, about discovering, too late, that the system worked differently than she had believed her entire adult life. Now, I want to name the psychological pattern underneath this mistake, because understanding it is part of preventing it for couples who still have time. The Social Security claiming conversation almost never happens in the context of survivor protection. It happens in the context of cash flow. The question couples ask is, when should we start taking our benefits? Not, what happens to the surviving spouse's income if we get this wrong? And the higher earner, the person whose claiming age matters most, is almost always the one who feels the greatest pressure to claim early. The money feels earned. The benefit feels like it is sitting there waiting. Waiting until 70 when you are already 63 feels unnecessarily cautious, maybe even pessimistic. What the brain does not naturally compute is the 15 or 20-year consequence for the person who will outlive you. The higher earner optimizes for their own timeline, which is completely human. But the widow's tax torpedo lives precisely in that gap between what is natural to think about and what is most important to plan for. The fix is not a financial product. It is one conversation held before the decisions are made with the right information in front of both people. That conversation is what this video is designed to make possible. So, let's make this practical. Number 1. Identify the higher earner in your household and treat their claiming age as a shared decision, not an individual one. The higher earner's benefit becomes the survivor's income floor. That makes it a joint financial decision for the household, not a personal preference for one person. Number 2, model 3 specific scenarios: age 62, full retirement age, and age 70 for the higher earner specifically. Log into SSA.gov, pull up the My Social Security portal, and write down the projected benefit at each of those 3 ages. Then, calculate what the surviving spouse's income would be under each scenario. This single comparison changes the conversation from when do we want to start collecting to what are we choosing for the person who is left. Number 3, if the higher earner plans to delay, build a bridge budget. The most common reason higher earners claim early is cash flow pressure. If delay is the right strategy, the household needs income from somewhere else during those years. Map out which accounts you would draw from: a 401k, an IRA, a Roth account, a taxable brokerage, and in what sequence. A financial planner can help you structure those withdrawals in a way that minimizes taxes while protecting the Social Security delay. Number 4, if you are already widowed, do not assume you know all your options. The SSA allows surviving spouses to claim one benefit first and switch to the other later, what I call the survivor switch. According to the SSA's own guidance, a widow or widower can apply for either the retirement or survivor benefit first and switch to the other, higher benefit at a later date.
If you claimed a survivor benefit without exploring whether your own benefit would eventually be larger, that conversation is worth having with a Social Security specialist before any switch deadline passes. Number 5, have this conversation with your spouse this week. Not eventually, not after the next financial review, this week. Pull up SSA.gov together. Look at both of your projected benefits side by side. Write down what happens to the surviving spouse's income under different scenarios. That exercise takes about 30 minutes. It costs nothing, and it closes a gap that for too many families only gets discovered at the worst possible time. Before you close this out, I want to give you one concrete thing to do. It will take about 20 minutes. Go to SSA.gov and open the My Social Security portal for the higher earner in your household. Write down 3 numbers, the projected benefit at 62, at full retirement age, and at 70. Then subtract the age 62 number from the age 70. Multiply that monthly difference by 180. That number is the minimum lifetime income difference the higher earner's claiming age creates for the surviving spouse, based on 15 years of survivor retirement. Write that number down, show it to your spouse, then decide together whether the decision you are planning to make deserves the 20 minutes you just spent on it. One thing that arrives without warning for many surviving spouses at the same time as everything else is a healthcare expense they were not expecting. The gap between losing a spouse's employer coverage and Medicare eligibility, or finding out that the current Medicare plan no longer fits a single-person budget, can cost thousands of dollars in a single year. Chapter is a free Medicare advisory service that compares every major plan from every major carrier based on your specific doctors, your prescriptions, and your zip code. No sales pressure. Insurance companies pay them. You pay nothing. You can reach them at askchapter.org. The link is also in the description below. The widow's tax torpedo is not inevitable. It is a planning problem. And planning problems have solutions, but only when you find them before the moment they matter. The day one Social Security check disappears is not the day to learn this. Today is. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing. Or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye.